Well, 10 U.S. banks are facing a deadline today to explain their capital raising plans to regulators. These banks are planning to rely on preferred stock conversions for 22% of their fundraising, which means it's not fresh capital coming into these banks. Well, let's get back to Washington and to Bert Ely, Chief Executive Officer of Ely Co. He's an expert on banks and has testified before numerous congressional committees on banking issues. And Bert, good to talk with you again.
Glad to be here this morning.
What do you make of, and we've known this for a while, but what do you make of a large portion, at least for some banks, even a third, up to a third, of the capital being raised as just merely conversions from preferred to common stock? What do you make of that?
Well, what the perceptions developed in the markets in recent months over the last year is that common equity capital is a higher quality of capital. That's why we see all this emphasis on tangible common equity ratios, or TCE ratios. And that's what some of these banking companies are doing, is basically not increasing their total capital, but just trying to have equity, common equity as a greater portion of their total capital. Now, one of the advantages of that is when the preferreds convert to common, that eliminates a dividend requirement, which can help the cash flow of the company, and so that is a positive in that regard. But there is an element of window dressing. There's no question about it.
An element of window dressing, but is it enough to worry investors or no?
Well, many investors seem to prefer it, again, because of this notion that common equity is, quote, higher quality capital. So I think to a great extent the banks are, in effect, responding to these perceptions in the market that common equity is a much better form of capital than preferred stock. And the regulators seem to be buying into this more and more also.
Right. Okay, well then overall then on the bank industry itself, Bert, as these banks are raising capital, and I know that Bank of America, Citigroup, they're well on their way to doing so and meeting those requirements by the government. What do you think, though, the banks should be doing during this time that they're not doing right now?
Well, I think the banks are, these individual companies are doing pretty much what they should be doing in terms of strengthening their capital positions overall, positioning themselves to get out of the TARP program, which I think is very important for them, and to basically stabilize their operations and deal with the sins of the past. That is the problem loans and securities that they have on their books. And so they're trying to work through these problems as the economy bottoms out and starts to recover. We're also seeing in some of the companies some significant senior management changes and board-level changes, such as at Bank of America.
And yet there's still criticism, though, of course, that these banks are dealing with their capital side of the issue, but not about the toxic assets still.
Well, I think there's a lot of room for disagreement on that. First of all, as the banks raise capital, it gives them the capacity to hold those toxic assets. But the thing is that for many of these banks, it's really not in their stockholders' interest to sell these so-called toxic assets at very low prices. And if this is a good deal for investors to buy toxic assets, it's also a good deal for these banks to hang on to them if they have the capital capacity to do so, which is one of the reasons why they're raising capital, so that they don't have to sell at bargain basement prices.
Okay, and Bert, in the short time that we have, I mean, Citigroup, well on their way to raising their capital as well. What about the future of CEO Vikram Pandit?
Well, that's, of course, a big question mark. Sheila Bair, the FDIC chairman, apparently is trying to push him out. Hard to say how that's going to play out.
Okay. Bert Ely, always good to talk with you, CEO of Ely Co.